folks who don't know me, thank you, Jenna. I am Divya Kakad. I'm the head of platform at Graham & Walker. So nice to see where everyone is dialing in from. It's always wonderful to see how large our community is and that we have founders from across the country dialing in. For those of you joining us for the first time, and for those of you who don't know Graham & Walker, we are a venture firm on a mission to reshape the NASDAQ. And we do this by supporting and investing in tomorrow's most powerful companies that you are building. So really quickly, I know, as you know, for the first hour, we're going to be talking to Leslie Feinzaig, who's here. She is the founder of Graham & Walker, and I'm going to introduce her in just a bit. But if you are planning to join us for the co-founder, founder networking session that's going to occur after this discussion, please fill out the poll that you see now that's going to pop up on your screens. Oh, it just popped up on mine. I can't see your faces anymore. Just a second. So for the first question, if you can just rank the industries for the breakout room that are most relevant to you or the idea that you're hoping to pitch, that would be really great. And for the second question, let's see. Let us know if you are planning to pitch or not. And when it comes time, you will only be going to one breakout room. So that's what that's about. And I'm going to close this out for myself and give you guys maybe just another minute. Make sure this happens. And then I'm going to get into introducing Leslie. Okay, let's see how many folks in the room today. Okay, we have quite a crowd here, Leslie. Okay.
I'm still me, aren't I? I'm like talking to myself in here.
No, you're. I'm really excited for the discussion. So today we are joined by our very own Leslie Feinzaig. Leslie, of course, is an operator turned founder turned VC. In 5 years, she has turned a 25-person Facebook group into a 50,000 strong community for women-founded startups and aligned investors, and raised a venture capital fund to invest in and with the best of them. She is the founder and managing director of Graham & Walker, and we are all on this mission together to reshape the NASDAQ by investing in tech companies founded and led by women. As you registered for today's conversation, some of you put in some questions that I have included in our discussion today. But of course, while we are talking, feel free to add in questions in the chat. If you don't want these questions attributed to you, that's totally fine. You can DM me, and I can just ask them to Leslie as it comes up. And if we don't address any questions while we are talking, we can also address them at the end. We'll try and make it an interactive session where you can ask the question to her directly. So with that, let's get started. Okay.
Sure.
All right. Leslie, I know we talk all the time, and I know I'm very excited for
you. Today, Divya.
I mean, we only met, I don't know, this morning at stand up. Okay, so I mean, we've done this AMA or a similar AMA a couple of months ago, when the market started doing its thing. But for everyone in this room, I want to recap a little bit or ask us some of those questions again, because maybe there's different answers. Everyone knows that the public markets are down, the economy is slowing. But how is this affecting early stage venture capital, and why should pre-seed and seed stage founders care?
Okay, so I'm going to start with some, and actually, before I answer that, can I get a show of hands in the audience? Can you raise your hand, like raise your virtual or actual hand? I'd love to see actual hands, but it's up to you. Raise your hand if you have a company that you have been working on for a few months or longer, like an existing startup. Let's see those hands. It's about, is it like more than half the group? Yeah. Are there any founders in here who don't have a company? You're just like, hey, I just left my job, or maybe you're thinking of leaving your job, maybe you got laid off, you want to start something. Like, is there anybody here who is like net new, I'm going to start something new? Started doing kind of Brooke Jennings, like that. I know that name. There's some names here that I know. Hello, everybody. Okay, let's see. So we have 5 folks. No, we have some folks who are like starting. So we have both groups, both founders that have a startup that potentially predates the change in the market, and some founders that are kind of net new post change in the market. So let's start with some context. Venture capital, like the venture capital has been growing as a category pretty steadily since 2008, which was the last economic recession and downturn. And in the last 2-3 years, like certainly around 2020 and later, it kind of just exploded. And not in the, like, it's not that there were more and better ideas than before. It's the availability of money that was looking for new avenues for growth. The supply of money exploded. Why? Because the markets were really frothy. I mean, I could really nerd out about this, and I probably, like, I'm an economist by trade, so I could like really go on, so I won't. But you know, long story short, there was a lot of cash out there, and that cash was looking for long-term growth. The market, like the public markets, were like super high. Interest rates were super low. And so investors had to go and figure out, like, where do we find growth? And they were looking for riskier and riskier bets to find growth. And so we ended up seeing a huge influx of cash into venture capital coming from different, like from places that would have otherwise been invested differently. So cash from crossover investors like Tiger, gigantic mega funds from SoftBank, and then even the originators of the money, the limited partners who invest in VC funds, were putting more and more money to work in existing VC. All of that money started making its way down to founders, and it just created so much supply of capital that it made the market really hot. And for founders, not for all founders, we'll get to that in a minute, but for a lot of founders, what this resulted was like just a bonanza of venture capital. For a lot of founders, it was super easy to raise. They could raise basically on an idea. They could raise with limited to no due diligence. They could basically play off venture capitalists against one another. VCs knew that, like, if the company got hot enough, Tiger would come in and like they would lose. So venture capitalists started competing with each other, and the competition between venture capitalists started bidding up the price of companies. And I realized that this is like a really shitty thing to hear as a founder. I probably already started swearing, but that made it for an extremely founder-friendly market. And again, not evenly distributed, but by and large. What happened, a lot of things happened, but the primary thing that changed is that capital pulled back from venture capital. So crossover investors are feeling pain, both in like the stupid VC bets that they made, and also in like the public markets that are losing their value. And so they're pulling back from venture capital. Swearing is valid. Thank you, Liz. Yeah, I agree. We're among friends. I'll try to not swear too badly. So we're just pulling their capital back. There's like less capital sloshing around. And then there's like a great phrase that somebody said, I don't know who to attribute this to. It's not original, but something like, when the tide goes out, you find out who was swimming naked. It's very graphic. The point is, like, now we're finding out who was swimming naked, and like they were really big naked bets, right? Like, how did they possibly invest that many billions of dollars into a financial services company? I'm talking about FTX without a board. Like, it's just like it's such a simple, you know what I mean? Like, without any financial oversight, with like a whoopsies, we didn't know where the money was. Like these are just like giant errors in oversight that, you know, the reason that was happening is because VCs had to play by those rules or lose out. And if they lost out, it's really hard to go back and explain to your LPs like, hey, there's a super hot company called, you know, FDX, like, why aren't you in it? With less money going into venture and all of those excesses kind of coming out to light, the originators of the dollars, like the limited partners, where the big dollars come from, are now being harder on VCs theoretically. And VCs are being harder on their portfolio companies. So like all of this basically results in a lot of, are we recording this? And like a bunch of VCs that are basically doing their jobs. And in like, I'm a VC, I've been doing my job this whole time, but you know, there's like much more emphasis on actual traction and metrics in the companies that people are investing in. There's a lot less competition for deals. Like VCs are just kind of going slower. And why should founders care? Because that makes it, I mean, for the vast majority of founders, that makes it a lot harder to raise. And it is resulting in lower valuation caps. So like you're going to raise terms that are kind of pre-2020. It's resulting in slower fundraising processes. So if before a second-time founder, like somebody that's somebody that is like really well known and like a year ago would have raised in like a week off of a deck, now has to run a real process. And like what we call running a process, like if you've ever participated in a Graham Walker fundraising masterclass and or Catalyst or anything like that, like what we call running a process is a lot harder because VCs are taking their time. And so you can't create that fear of missing out. Like you can't create that like urgency for the VC to make a decision. And all of this results in a much harder time fundraising. I think that answers your question, Divya. Should I like?
Yeah. Yeah, I think so, because this sort of lends itself to our next, my next question, which is, this is true. It is a harder time for founders to raise. But at the same time, you always said, and I mean, I hear this a lot, which is downturns are the best time to start something new.
Yeah.
And the best companies that exist today were created in the last big recession. So talk to us a little bit about why founders should be optimistic at the same time.
Yeah, and it's sort of like, doesn't mean that it's easier. It's like, okay, have you guys ever heard of the 3 types of fun? Like, raise your hand, have you heard of the 3 types of fun? Like, this is the thing that my husband taught me. He's a climber, like an alpine climber. So type 1 fun is like, you go to Disneyland or Disney World and like, that it's going to be fun, like, haha, or like you watch a funny movie and that it's going to be fun. It's like easy fun. Type 2 fun is like, you're going to go for a hike and you have some rain and like it kind of sucks and like you get your shoes wet and maybe you get some blisters, but like, hey, it was still fun. You got a story out of it. Type 3 fun is like, it's really going to suck. And like, you might get like a funky like fungus on your feet and like, you're just going to get some scratches and yeah, marathon run. There you go. Like, it's just really, really going to suck and be really painful, but you're going to have a great story out of it. And like one day you're going to be like, oh, remember when we did that like really horrible, hard thing? Wasn't that fun? It's sort of like, actually, you know what a good example of type 3 fun? Childbirth. Yeah. So basically what's happening now is you're about to have some type 3 fun. All right. Like it ain't going to be easy. It's not necessarily going to have, what are we doing? It's not going to be pleasant. It's going to be really hard, but really great companies come out of that because, sorry, Liz Bradley. When there's too much money, when you have too much money in the system, it really glosses over the problems. it really glosses over the problems. And when it comes to high growth companies, you really want to figure out the problems fast. Like you don't want to mistake a real fundamental issue with like, oh, we just didn't have enough money to like pay for X thing or like hire the contractor. And so that basically means that like having less money in the system makes for entrepreneurs who are like really forced to confront the problems in your company from day one, and like either fundamentally fix them, like just like I like to say, like look it ugly in the face and like fix it, or shut the company and work on something else. So like if you have very limited resources in the beginning, you kind of have to do that. And I realized that like it's hard, it's not fun, you know, but frankly, if that's, you know, nobody gets into this because it's easy, you know what I mean? So it just kind of changes how you think about running a company in the early days. But what I can guarantee is like the companies that come out of this vintage, like this period of time, are going to be the strongest in the generation for sure. Oh, hey, I see Diane Lansinger. Hi. I'm seeing some like friendly, familiar faces here. So exciting. Divya, back to you. I have the release today. I'm sorry.
What?
I have the release.
You're like blipping out for me.
Am I? I'm sorry.
No, it's okay. If everyone else can hear you, it's probably okay. Everyone else can hear. Okay. Don't worry about it.
Should I grab my microphone? I'm not going to because it's going to screw the audio up. So let's just keep going.
It's fine. Yeah. Okay. So I mean, I love that. I think you're right. It is a hard time from a funding perspective, but this is how founders should be thinking about their company anyway. Like it was last year that was the last couple of years that was the froth, and that was now is the
exception. Like this is how it should be.
Yeah. So let's start with a question for so many of the founders that are over here that are really just starting out. They're right at the beginning. That's what we want to have this conversation today about. This is a great time to be starting a company. How do you get started? What should you be thinking about when you have an idea and you feel like, okay, this is a problem worth solving. I want to dedicate the next, let's be real, 10 years to solving this. What's the best way to test an idea out when you're at that earlier stage?
There's a few different things that you can do depending on how evolved your idea is. So the first thing that I would say is don't worry too much about the idea itself. I think one mistake that I made when I was a founder or when I first left a job to start a company was this like obsession, like, do I have the perfect idea? Is this the right idea? Is this idea strong enough? And I think what I've discovered is not just in my own journey, but watching others is like, first of all, I hate to break this to you if you have not heard this before, but your idea is not unique. I'm telling you right now. It's just not. Like when you see the volume of people that are trying to solve similar problems, most ideas are derivatives of each other. And that's totally okay, because what's going to differentiate you is not the idea, it's the execution. So the first thing that I would say is like, don't worry about the perfect idea. The second thing I would say is like, it's much more interesting as an investor, as a founder / builder, but also for the long-term success of a company, what is much more interesting is a problem than an idea. So if you think of like, what is the sort of problem statement? Like, what is the problem set that interests you uniquely? I think that is much, much more worth exploring than like, I have an idea. I'm going to do like a razor blade model for hair care, whatever, right? Like, so think about like the problem statement. And then again, if like the concept of what you're going to do is not super, super well developed, I think that the best place to start is to have a lot of conversations about it. And this is also another thing that like, as a first-time founder, I did wrong. And so it's like such a classic first-time founder fallacy, which is like you get really, really paranoid that somebody's going to copy your idea. And the thing is, like, like somebody's, if it's a really good idea, somebody's already working on it. You know what I mean? Like, just so don't worry about that too much, unless you're like literally chatting with someone who's like a complete a-hole and like, you don't trust them, you don't talk to them to begin with. Otherwise, I feel like the best thing I did like way back then is like 8 years ago or something like that was, okay, I think that these are the problem sets that are interesting to me. It was a lot around like parenting and like educating kids. And I just started talking to people about it. Like I would have coffee with like other founders, with people like ex-colleagues, and I would talk to them about what I was interested in. And either like they were kind of people who fell into that problem statement and could give me kind of some human insight about what their experience is. And so that would like spark my imagination and my innovation and like develop the concept a little bit further. Or the other thing that would work really well is that inevitably they would know someone who has some experience or is interested in the space. And so I would like, for every coffee meeting that I had, I would ask like, hey, can you think of anybody that I should talk to? And I ended up having like 100 coffee meetings within a couple of months or 2-3 months, something like that. And at that point you develop a network, which is going to be the most important, like powerful thing that you build. So if you're in the very, very early days, that's where I would start. I would start by like literally having conversations. And then at the point where like, okay, now you have a real concept for what the solution to that problem is, like what you're actually wanting to build. I would say the next step is, paradoxically, not to build it, it's to test it. And so you want to somehow, I'm going to oversimplify this, but you're going to somehow fake the product or like create a marketing page for signups only to start testing whether other people think that this is worthwhile and interesting, before you spend any time or resources actually building the thing that you think is the biggest solution, like the right solution. I could go on at length about this, but like I'm going to leave it there as like an outline.
I love that. And I think it's so helpful, I think, for founders to hear this, because you're right. Like most people that have ideas are paranoid and will not want to share, and really like being in stealth mode. Even if you are in stealth mode, I mean, I understand sometimes there are reasons to be in stealth mode for other reasons. Maybe you don't want your employer to know. Maybe you're like trying to keep it.
I don't want to like
fine.
set expectations for like, you don't want to like have like people have really high expectations of what you're building. Like I get it. Like there's reasons, but yeah, like.
But having said that, unless you don't actually go out and talk to people,
like you're like literally like copywriting or like like you're like patent level, scientific invention, then your idea is probably not unique. Like you can talk.
And okay. I think it's helpful to say that out loud and keep hearing that. And then I also love this idea of like testing things before building. And that's because you spend a lot of time in building, and then, what's the point of building something and then learning that it's actually not solving or helpful. Also, as being on the other side, as investors, you're always looking to talk to founders who are proving traction, who have a demand, who are trying to, so if you're sort of building that up right from the beginning, it just shows that you're actually first going after the people for whom this is a problem and that need exists. And then you're sort of listening to them and using them as a sort of, to sort of go build. So let's now go a step further. Okay, so most founders that are starting, creating a tech company or using technology in some way think that VC is the way to scale, or the only way for them to fund their idea. How does someone know if their business is right for VC, or is it a lifestyle business? And hey, there's no right answer. Like, it can be a perfectly great lifestyle business. So how do you think about that? And maybe speak a little bit about when is the right time to be approaching a VC, if it is a VC business.
And as it like, it's funny you're asking me this because like you've heard me talk about it in like every fundraising class that we have ever given. But so the first thing I would say is I hate the word lifestyle business when it is used despectively. Like, who here wouldn't love to have like a $10 million in revenue profitable business? You know, like, Jesus. Yeah, like that's a great business. So like, if
that's all mine that I don't have to pay investors for. Oh.
Yeah, man. Like we are doing the world a disservice by speaking of these like lifestyle businesses despectively. Like, those are great businesses and they can be life-changing, like generational wealth creating. You know what I mean? So if you have one of those, please, by all means, do not raise capital for it. Just like take the profits and like get rich and then come invest with us. Okay. With that being said, so venture capital, what it is a like a subset of the financial services industry, right? So like, we are investors. We invest in companies. So like, we give money to companies in return for some level of ownership. That's no different than like investing in the public markets, right? Like, you're sort of giving money to a company and getting some ownership in exchange. The difference is that venture capitalists are investing in the very, very earliest stages of a company when like the risk of it turning into anything at all is very, very high. So there's like, we're kind of buying an enormous amount of uncertainty and like trying to use our resources, our know-how, and our expertise to help that company have an outsized outcome. The thing that makes that VC different is that we are looking for companies that can scale. And I like to sort of have founders think of the word scale in contrast to the word grow. Any business can grow, okay? When I think of growth, I think of like some form of either linear growth in the business, right? Like, we grew 10% this year, we grew 20% this year, we grew our revenue, right? Generally, that growth comes with a fairly consistent growth in the cost side of the business. So basically, the more you grow, the more expensive it is to run that company, and your profit margin stays relatively constant. A VC business is scalable, and scalable kind of refers back to what we would call economies of scale. And what that means is that you can grow that business exponentially while holding the costs fairly steady. Does that make sense? And so the margin of that company can grow exponentially. What does it take for a business to be venture scalable? So first is, there has to be a lot of room in that category for a like really, really gigantic company. So like, either people need to be spending in that category enough, it has to be able to like consolidate, right? Like, there just has to be like a really high long-term revenue opportunity for a single player or for multiple players in one business. The second is that the business model itself has to be scalable. And so just think of it as like, the margin has to get better, like substantially better, the more that you grow the company. And those are kind of the two things that make the company itself scalable. So if you contrast, for example, a chain of gyms, okay? And you're literally going to have the same cost structure and a limited revenue possibility for each gym based on how big it is, literally, like how many people you can fit in there, because there's only 24 hours in the day, right? Like, there's only 10 or 20 20 machines, right? And there's only like 1 or 2 aerobics rooms. And so you can only fit so many people there, and you're going to keep paying the same rent, and you're going to, keep paying instructors. And if you want to double the size of the business, you're also going to double the size of the cost. That's a lifestyle business. You can make like amazing revenue. You can even take it public. Like it has nothing to do with the ownership structure. The difference is, think of well, Peloton is now disgraced, but like think of a company that can have like that same category, but whose cost structure does not grow relative to the revenue. So you can double the business without doubling the cost structure. That is a massively scalable business. Peloton does it by charging subscriptions that like you don't need a third Ali Love, right? Like you don't need a bigger, you just have like this massive installed base and keep charging them a monthly subscription with a very, very low cost structure. So the third thing that is like a really, really key difference is that the founder has to want it, right? Like, and I think it's really worth, like, even if you're in a category where it could be scalable, it doesn't necessarily mean that that's what you need to do or what you should do or what you want to do, because what you're signing up for is a very punishing, punishing decade. You're signing up for essentially losing control of your company. So like the whole point of the thing is that you're going to sell the company later on, either to an acquirer or to the public markets. And yes, you might be the Mark Zuckerberg who keeps control of their company for 2 decades, but most likely you're not. Like most likely you're going to give that company to somebody else to run. And so you kind of want to be rich, not king. And it's going to, that is the intrinsic motivation behind what you want to do.
Got it.
I'm looking at the chat room, but like I should look back to Divya. So.
No, you're fine, because there was a question that came in the chat pertaining to a previous, question where we talked about building, testing before building, and I think it's worth talking about. So the question is, can you actually raise capital on marketing findings or through a marketing page before you actually build something? So as an investor, like maybe talk a little bit about.
100%. I mean, there's some VCs and some angels that like want to see a product that exists. The reason for that is generally because they don't believe that you know how to build it, right? Like if you've never built anything before, then they're like, okay, I don't want to invest in somebody making mistakes with their engineering team. But if you do have experience shipping product, or your team has experience shipping product, then I think like I'm very happy. Like I will invest in a pre-product company, but not in a pre-traction company. That's just like and you'll hear a truism out there that like first-time founders build product, second-time founders build distribution. And the reason for that, and by the way, I'm talking about like rapidly commercializable software or products, right? Like stuff that you can sell. I'm not talking about deep tech, long-term technological development. Like I'm not talking about if you have a PhD research project in like edge case biotech and want to start a company off of your innovation. That's not what I'm talking about here. I'm talking about like you want to start a company with like technological capabilities that are available today. And the thing that I like to tell founders, and by the way, I tell this to my own investors as well. If you think of the problems that you want to solve out in the world, again, if you are not the PhD researcher, like if you are just like you and me, right? Like I'm a mom in a basement and I'm looking at the world and I want to start a company. I'm like a problem that I can observe and understand. Most of those existing problems today, if they are unsolved, the reason they're unsolved is not because the technology doesn't exist, right? Are you following? Technology can do amazing, amazing things. Most of the things that you can imagine to solve your everyday problems are buildable today. Like they are no longer science fiction. The reason those opportunities still exist is because marketing is hard and expensive, right? So like if you see a problem out in the world that is not solved, you have to assume it's not because it's hard to build, it's because it's hard to reach the audience. And that's what you're doing when you're like faking the back end or like doing distribution before you do. So again, interesting, like if there's any PhD researcher here just working on like some like really interesting deep tech stuff, please by all means pitch to us. Very different use case. Most venture capital is not going to that. Most like that stuff, it's like NSF grant type stuff, right? Most venture capital is going to people who want to use existing technical capabilities or push the possibilities of technology into things that can be sold in like 6 to 12 months. And for those, the challenge is marketing, not building, you know. And if there's engineers here, we can argue about it, but I think that that's where like the biggest problems are today.
Yeah,
Oh,
agreed.
really long on that one.
No, it's fine. This is all good conversation. I'm sure the chat is like going crazy, so I feel like everyone's very happy with everything that you're sharing right now. So I think the next thing I want to ask is, okay, but so for founders who you have the problem, you are sure this is venture scalable. Next thing, you know, you want to start raising the capital. Where do you start? How do you start on that journey of asking the very first circle, right? Friends and family, angels, like how does that process begin?
So first, I will acknowledge that not everybody has rich friends and family. I don't make the rules. That's just kind of what it is. I would also say, so, okay, I'm going to give you two opposite but equally relevant answers. Okay. On the one hand, I think it is not healthy to raise first. Like, I think that you should always be passively raising, like building relationships, you know, like meeting investors, building up your network, getting the word out there. That's different from running a fundraising process before you start like doing anything else. So I would say, and I realize this is hard because, you know, we need income to live, right? And so there's a lot of privilege in being able to just sort of not raise and do the thing. If people are employed, I would say, don't quit your day job and just do this on the margin, test it, build that distribution, build that network. Don't raise, just keep bootstrapping until you have like a real why now for the fundraise. So that's the first thing that I would say. Like, I tend to think that like the companies are much healthier when they start off drastically resource constrained. And I also, when founders just have an idea and immediately go out to raise, I question their motivation. I truly do. I have this like philosophy that, you know, success is not the fundraise. Success is the outcome of the company. And if you get really meta about the thing, success is how you spend your life. Like, it's not even the company itself, it's how you spend your time. And so to me, that means that every discrete fundraising period and process should not be judged by the success of that fundraise, but by the success of the company in the long term. And that's, I think that like the VC industry just sort of lost that over the past few years. And I think it's really healthy to come back to it. Like, don't raise, just build. And I promise you, like, if you build a thing or like build an audience and a distribution and then a VC season, and we're like, what the, how did this, you're going to get the term sheets without, you know what I mean? Like, we're like, we will end up coming to you. It'll be much easier to raise after you do that. So that's one answer from the heart. If I could, like, if I was going to build a company today, that's how I would do it. The other answer that I will give you is, if you have the ability to raise, don't sell yourself short. If the guys do it, you know what I mean? So like, there are definitely VC funds with a lot of dry powder, which means like investable cash ready to be deployed in the bank, and they are by and large deploying. I think you're going to find some VC funds are very focused on their existing portfolios, so like it's hard to get their attention right now. But there are funds out there. I think a lot of VCs that have new funds and this dry powder know that this is a great time to be investing, right? Like everybody understands that we are back in 2008. Like this, really amazing companies are going to come out of this entire thing, and so we're looking for them and we're investing in them. So yeah, by all means, like start developing the relationships. The money is out there. It is harder to get. I just think. I think that your company will be healthier if you figure out what your business is first before you go get a bunch of money and start building product.
Agreed. And Liz over here is asking, and I had that also as a question, which is, so say you are deciding to fundraise and we talk about early traction. What is an example of early traction that would be exciting for, an investor to see?
Yeah, so that's really hard to answer in generalities because it's very
specific to.
Yeah, it's sector specific, it's business model specific. Yeah, it's extreme. Like if you're doing like consumer technology, then usually it's like a very large wait list or a lot of people downloading your thing and using it, right? Like acquisition, engagement, retention metrics. If you are building an enterprise company, then it's probably like the number of companies in your pipeline that can be customers. You might have some letters of intent, LOIs signed with them.
Yep.
So it's like the size of your pipeline and how fast it converts. And obviously you don't have the thing built yet. So it might be that it's converting into design partners, right? So like, it's sort of that idea that, hey, there's these enterprises and they agree that like they have this problem, they're willing to pay for it. And they're so excited about you specifically, this team specifically, that they've decided to like co-build with you. So it really kind of depends on what business you're building.
And then I know what your answer is going to be, but what stands out to you, Leslie, when you meet a founder and when they start pitching? Like I think for first-time founders, they sometimes they spend a lot of time on the deck, on what it's going to sound like. But we know that there's something more that stands out first to an investor. What is that for you?
So I do think that the deck is not that, it's not that the deck is the thing that makes you want to invest, but it definitely makes you not want to invest. So that like the opposite is true. And I'll give you the reason why. And I know how, listen, I have to build a deck to raise capital for my fund too. So I'm there with you, I get it. Like, but the thing about the deck is, if I don't understand what you're doing on your deck, your customers won't either, other investors won't either. Like you're not gonna be able to hire people. Like if you don't know how to communicate what you're doing, you are dead in the water. And so in that sense, the deck is really important because it has to sort of, it's not that like it's, oh, this deck is what makes me want to invest. It's like, if I don't get excited, nobody else or very few people will. Or even more fundamentally, we have a truism at Graham and Walker. Like Rory and I would do all the first meetings, and like sometimes we see a really bad deck, but it's a space that we really like. And when I say bad deck, I mean a deck that we don't necessarily understand, right? Like it's like there's so much stuff in there, and like it seems like it's all the right labels, but we don't really get like. And we give them a chance anyway because we really like the space, or maybe the entrepreneur has like a really interesting resume or something. Every time that we don't understand the deck, we don't understand the pitch either. You know what I mean? It's a telltale sign that you don't know what you're doing yet. So that's why the deck is important. It is what it is. But it's not what makes us want to invest. I think it's more to do with like a combination of the person. So like there's a relentlessness to these entrepreneurs that is like not off-putting, right? Like incredibly confident, but also very coachable. For us, for me, like I'm very put off by people who know all the answers, because I feel like it takes more confidence to not know the answer than it does to just sort of pretend you do, right? Like I like vulnerability. And I like sort of the strength to kind of know your own weaknesses and be able to acknowledge them. So like I look for like real humans, I look for real maturity. We look for real substance over hype, like that. It's on, if you've ever emailed with any of us, it's at the bottom of all of our emails, because we truly like, we're looking for substantive people and substantive businesses. And venture capital is built on a lot of hype. Like it's built on a lot of like, you know, this round is closing by Friday, and if you're not in, I'm like, all right, well, congratulations. Like, good for you. Like, I'm not participating in that. But it's really, because even that is not, I mean, for us to invest, there's a lot of things. Some of them have to do with the entrepreneur, some of them just don't. But yeah, what really makes something stand out is like the founding team, and the founding person. It's hard, you know, like I said, there are definitely founders and founding teams that absolutely stand out and we still don't invest. And actually that happens very frequently. That's the best answer I can give. It's really, really hard to describe.
I hear you. But there's another interesting question here, which I think it's good for founders to, a lot of founders ask us this, and we see it all the time. How much does it hurt you to be a solo founder when pursuing funding? I don't even know if that's the question, but let's say as an investor, do you put solo founders in different buckets, or how are you thinking about them?
Yeah, like truthfully, yes. And
why?
Because it's so two things. One, it is really hard to build a company and fundraise. Like all of this is really, really hard. If you're doing it alone, you immediately have you're immediately at a disadvantage. That's number one. So it's just like the practicality of like, it's too much for one person. The second thing is building a company is all about convincing people to do things when they could do something else much more easily. It's like convincing people to buy your product, even though there's like 1,000 others out there. It's convincing people to invest in you, even though they could be investing in another 150 startups in like the same space. It's convincing people to come work for you, even though they could be making $200,000 at, Microsoft. And if you can't even bring on a friend, how are you going to do the rest of it? Because like, I'm telling you right now, money does not solve that. Like, money just does not solve that. And so not having a co-founder or like an early team makes me very concerned about their ability to convince people to do things that, they don't need to do. That's the big reason.
Yeah. No, I think it also extends to being able to fundraise, right? Like if you're not able to inspire, and I say inspire because in order to bring people along with your journey, you need to be able to show them that vision and make them believe that you're going to go build this thing. And so that's why the first validation of that is when someone says, okay, I'm going to join you on this journey.
I'll work for you. Yeah.
I'll work for you.
I'll work for you. And Liz, I see your follow-up. Yeah, absolutely. It's like, I don't actually care so much about the titles. I care about the commitment of the people. I do. Yep. I care deeply about it. I feel like I don't have a co-founder, right? But I have the only reason I don't have a co-founder is because I wasn't founding a thing when I ended up founding the thing, like it wasn't a company, it was like a project on the side. And so by the time that Rory joined and then Divya joined, it was already kind of a going concern. So I don't have a co-founder myself, and I still go out and fundraise as a solo GP, but I have the best team in the world. We've been together for like 3 to 4 years. You know what I mean? Like, so it's not the title. In fact, once you do have a co-founder, then we look at like, well, how do they, what's their relationship like, and can they solve problems? And, so it's It's not a guarantee that it's going to solve the problems, but at least it tells me that you know how to recruit, like you know how to convince people to come along for the ride.
Absolutely. Okay, we have like 6 minutes left. So I want to make sure that if there are other questions that y'all want to ask Leslie directly, like this is your time.
We should do like rapid fire because I think we have 6 minutes. Do we just have 6 minutes left?
Well, we have more time because we then want to go into the networking, but I didn't know how much time, Leslie, you have, and if it's a hard stop. Because I have more questions, and if folks want to raise hands and ask questions directly, we're okay with that too. So while you all form your questions, raise your hands.
We'll go a little late. So
awesome.
We'll go a little late.
Oh, Alicia Dara, I love seeing you here.
I know, like friendly faces. Hello.
Hi, you have a question.
Just a minute. Hi, yes, I'm unmuted. Hi, it's wonderful to see you all too. Leslie, this is so incredibly inspiring as per usual. My question to you is, how would you define something in a company that really is a delightful surprise for you? So when you as a VC are looking to approach, a founder or a company, what are some things that they can bring out that really pop for you, that really inspire you?
The answer is generally around execution. So like, yeah, usually, it's like, yeah, it usually looks like some level of execution that like a lot of people gravitated to. By that same measure, if the opposite happens, like a lot of times people will, and you'll do like an accelerator program and they will teach you how to spin your metrics to look amazing. And your deck is like, whoa, like you got how much things, like, oh my God. And then you meet the person and you find out all the asterisks, right? Like, yeah, like, but that revenue has happened over 3 years. And that is so off-putting. Like, it is so off-putting. Like, you might as well I would rather just like be upfront about where you are and what brought you here. You know what I mean? Like, so yeah, usually the opposite of that is what is like really exciting to me.
Thank you. Amy, so nice to see you here too. I know you typed your question, but yeah, go ahead and just ask it.
Yeah, ask it.
Yes, so good to see you both. And apologies, this is a little too specific to what I'm doing, but I'd love your advice. Essentially, we're building, we're building kind of a giving hub for donors, but we're also building a community platform for nonprofits. So once people donate, they're entered into the nonprofits community. And we're charging a small fee on donations, but to the nonprofits, we're charging $100 a month, like a SaaS model. And the problem is that we've built out the donor side of the app and have great feedback where, we got 100 donors on the app in a month. We're like, cool, but we haven't started building the nonprofit side. But we're finding that the nonprofit SaaS side of it is more attractive to investors because it's like, okay, that's way quicker to profitability. It's less hard of a business model, all this stuff. So we're just trying to figure out right now how to kind of edit our deck and edit our story to communicate. And should we be focusing just on nonprofits as our avatar and communicating it from that perspective? Because that's kind of solving the really strong pain point. Whereas like the donor side is a pain point, but it's like more about transforming the donor experience for nonprofits to gain recurring support. So we're just trying to, my question is, should we be talking about both sides of the marketplace or focus on that in our story?
Yeah, so this is a really, really great, like in real time demonstration of why it's so important to focus on the problem and like fall in love with the problem and not with a specific solution. Because yeah, it sounds like you have a couple of different ways that you could like solve the problem that you're solving for the kind of the problem space. So thank you for demonstrating that for everybody, Amy. And also I'm not going to answer your question because I don't know. And the reason I don't know is because you could go either way. Like you could legitimately go either way. You have to sort of decide kind of on your own what the right thing for the company to focus in. What I would say is what it sounds like, I feel like either we've talked about this or this is a very, very frequent thing that we end up talking about post 2008, which is marketplaces are extremely hard and most marketplaces don't need to exist. and and when I say don't need to exist, maybe the right thing to say is like most marketplaces should not be venture funded, because when they are venture funded, they end up being Uber Eats, or right, like they end up really squeezing the gig worker, or like really squeezing one side of the market. And so for a marketplace to be really, really, truly venture fundable, the revenue that you're going to be taking from each transaction is either really low or exploitative, frankly, right? And so for it to be really venture fundable, the problem set, like the number of transactions on your marketplace has to be, I mean, like ginormous, like unthinkably big, like everybody in the world needs to do it. So that's the problem with like if you really want to do a marketplace, then you better make sure that the number of transactions on that marketplace is going to be like unthinkably large. Like you don't even know how to think of that many zeros large. Otherwise it's going to be exploitative. For whoever is like, you're going to have to increase your margins. And that is what I call, maybe exploitative is a really bad word to use. I apologize, but you have to get the money from somewhere, because you have to pay yourself and your team, and like seek profits for your investors. And so I think a lot of investors, they forget about, like, who cares about investors? I mean, like what the important thing is, what is the right thing for your company? If from the point of view of the consumer, there is a true need for marketplaces to exist, because like on the user side, right? The problem is when they're venture funded. And so if you can figure out a way to like keep your marketplace without raising capital, that might be the right answer. If you do want to kind of continue on the venture capital route, then you have to consider changing the business model, and relying less on the like transaction fee.
Right.
It's a lot harder. And so that's when like you get into like, okay, well, can you do some SaaS revenue? I cannot tell you how many, I mean, it's like every marketplace I see at the early stage, a year later comes back and is a SaaS company. Like it is a very, very common.
Really?
Yeah, absolutely. Because making money
It's hard.
is extremely hard.
Yeah. So the SaaS, could it be a SaaS? Because right now how we're building it is it's like a SaaS, but the marketplace side of it's almost like the moat that makes this community platform for that hub. And it's like, is that just too diluted, or like, have you seen that work?
Yeah, it's complicated. I think if you need to pivot, you need to pivot, and you need to, like, if you're going to pivot, you're going to pivot audaciously, like go big. Don't pivot shyly.
Okay. No, that's really helpful. Thanks so much, Leslie. Appreciate it.
Yeah, it didn't give you an easy answer, but it's an honest one.
No, that's great. Thank you.
Okay. Good to see you. Who else?
Thank you, Amy. There's a question from Julie here. I'm not sure I fully understand the question, but I'm going to ask it loud. How damaging is it if early founders make critical mistakes, such as overbuilding, operational errors, etc., but then fix them and put systems, teams, etc., in place to not make them again? This is not damaging. In my mind.
It's not damaging.
I'm not sure what if you're here, Julie, and if I'm not fully asking the question correctly, please feel free to raise your hand.
I'm here. I apologize.
Yes.
I'm not well, so I'm not on my camera.
No worries at all.
Thank you everyone for being here. Yeah, how damaging is it? Because I know there's like certain things that you read in articles, or you've been given advice of like, hey, don't make this one critical mistake, or don't do this one thing. But like if you recognize it and you deal with it early and you fix it and you move forward, you know, during that early, you know, the first 6 months or even the first year, because we've been going a little bit more slowly, intentionally, like, is that as damaging as everyone makes it sound? Or if you've been able to address it and fix it, does that actually show that, you know, you can kind of roll with the punches?
I mean, my gut is the latter. And by the way, I hope you get well soon, Julie. I don't know what's going on back there. My gut is the latter. Like the thing is, like, you are going to make so many mistakes. Like, you know, I would much rather know that you like figured it out and like fixed it and moved on. So yeah, I don't I don't think, but having said that, I do think that there's some mistakes that that you don't come back from, right? Like that you just sort of so it really kind of depends on what you're talking about, right? Like but those tend to be things that are not like a sort of one-time thing that can be solved in 6 months. Like yeah, for the most part, I think everybody makes mistakes. Sometimes we make really, really, really embarrassing ones. And like, you know, the key is not to be perfect. The key is to come back from, is to like get up after you screw up.
There's a great question here
Question.
by Malika. Would you like to ask it yourself? I see
Hello,
you. Yeah.
everyone. I am well. So hi, Julia. I hope you're feeling better soon too, but not camera appropriate. So I apologize. I'm in a weird space. But Leslie and everyone, great to see you. Yeah, this is just the spiral I came off of for the past few hours as you present the market size slide to different investors, and they have different very gut reactions to those numbers. Just wondering, kind of given everything you shared about today, and that being maybe different than things you can Google and find out in the past, what's a VC appropriate market size, big enough vision, or sort of, you know, grand enough scale that would work today? And I know it can vary wildly by market and industry.
Yeah. Oh man, like, can we just commiserate? Like, why is everyone so obsessed with the market? Like, dear
I
God.
don't know. I don't know. Tell me.
Okay, all right. I apologize on behalf of my industry. Anyways, okay, so here's what I have to say about this. The reason market size matters is because for a company to be VC scalable, there has to be enough expenditure in that market, and like the market dynamics need to be such that it supports another large player. So that's why it matters. But the actual numbers don't matter. Like, they are funny, like they're fun with math, you know what I mean? And so so I'll tell you what we do in our diligence process. We calculate our own market size for the founder. Like, even if the founder presents the market size, we will go back and calculate it ourselves. We'll calculate it both from the top down and from the bottom up. So top down is like, you go to IBIS World, or like you look at, like, you know, full industry reports from like researchers. Like, you literally go to the library and get reports about how much this category is worth, and then you cut it down to your specific problem. So we look at that, and then we do bottoms up, which is, what would it take for this startup to get to 100 million in annual revenue? So like, this many customers paying this much, retaining for this long, and like, is that something that we can see this startup building towards? So yeah, we look for like the top down market. We as a team look for 2 billion and more. And the bottom up, we look for 100 million in revenue or more. So like, are those achievable? Beyond that, like, I think that what matters about market size is that it is very, very large, and that you have thought about it, like that you're being intellectually honest about the problem that you're solving, and like how you are kind of getting into it. Beyond those two things, if you have really, really, truly been intellectually honest about your market size exercise, and you still get an investor that passes because of the market size, they're lying to you. That's all. Like, it's an excuse, and the reason is something different. And I apologize on behalf of my industry. Like, it's really, really shitty, but that's what's happening there, because and this is assuming that you are being intellectually honest. So I'll give you an example of not being intellectually honest with yourself. It's when you take the entire industry and present that as your market size. That's not specific. That's not real, right? So like, you are developing a toy. This just happened to look at a deck this morning, and you present the market size as 60 billion because that is how much is spent on toys in America every year. That's not intellectually honest. You have to break it down. So like, do the real thought process and like do the work, do the math, like present it, break it down. And if you do that and it does reach kind of top down 2 billion or higher, bottoms up 100 million in revenue or more, and you're still getting that feedback, you are either not presenting it right, or they're just sort of, it's a different reason. They just couldn't get there. And like, it's kind of an easy thing to point to. I know it sucks.
No, that's super helpful. Thank you so much.
It's so shitty though. Like, no, it is like, it's so shitty. Like, it's just, it is what it is. So do the work, you know, do the work, do the research, be intellectually honest, and then move on, because that investor is not being honest with you. So like, imagine when you have them on your cap table, that's not gonna be fun either.
Awesome. Thank you so much.
I'm gonna write
Okay.
about this. Investors.
I think
Stop
it
bullshitting
deserves
founders in the market size.
it's an excuse.
I'm gonna do this. I am. Okay, one more, or are we done?
Okay. I think if you can take one more, there's a good question by Marina. Marina, do you want to ask it? I can ask it for you.
Yeah, go for it.
Okay. Okay, so Marina's question is, as this is a female focus forum, what are some of the few things that female founders do that hurt them more in a male dominated capital industry? I think, are you asking specifically also regarding the fundraise?
Fundraising and just networking and just behaviors. Like, you know, I'll give you an example. I'm a mother, I'm a business professional trying to start a company. I don't have the opportunity to go and socialize and network evening after evening because I spend time with my family, right? How does that hurt me as compared to some of my male counterparts, for example? And what can I do to kind of overcome that?
You are preaching to the choir.
I mean, no, I don't like, I think like boozing it up with the guys at the end of the day is not a competitive advantage. It's just like, it makes you like, it gives you fear of missing out. So don't worry about that. I do think that like building a network and building your, not just a network is maybe not the right word for it, but it is a good word for it, right? Like people that know you, are observing you, or can help you, and that you can help them, that you can then like plug into at critical times in a business. That's the important thing. And yeah, you can do it out schmoozing in conferences, but you can also do it here, right? Like you can also do it like in a one-on-one coffee driven basis. And so just be more strategic about it versus like going out and like being seen everywhere. And it's hard, but like 100% possible. Like I have a, you know what I mean? I started this when I was pregnant with number one. I raised a venture capital fund with like a 9-month-old baby on my lap. Like just our own rules, you know, there's so many investors now that like, you know, I do like in the playground at Green Lake, you know, you can meet a founder there, and we will one day create a world where like you don't need to ask that question because it's crazy making, right? I do think one thing that women do that hurts us is pitch smaller. And so that is one thing that all of you can do better. And when I say pitch smaller, I mean like the man like Chad will pitch you, if everything breaks my way and also a little bit of magic and luck happen, this is going to be a gazillion-dollar company. So it's like believable because he's showing you all the things that will break his way and how that will hockey stick. Women will pitch you, this is what I'm confident I can achieve next year. It's much smaller. And like and then and sometimes I'll pitch you like, this is a conservative version of what I think I can do next year. I'm like, you're not, you know what I mean? Like, you're not trying to get budget for your team at Microsoft, man. Like, you're pitching venture capital, like be big and bold. So that's the one thing that I would say is like, don't, like venture capital is not the space where you undercommit and overdeliver. It's a space where you have to sell a vision and be really confident about your execution, but you really have to sell a vision. And so don't sell it short.
Thank you.
I mean, and hey, by the way, just like for the record, I could also give you a list of shit that men do wrong. Okay, so like it's not just there's nothing wrong with us. Okay, sorry, I'm off. Back to you, Divya.
Okay, there's a lot more questions, but do you, Leslie? I think this is. I mean, this is always a great conversation. But how does everybody feel? Like, do you show of hands? Was this helpful? Yes. Oh my God.
It's also so fun. I wish like everybody needs to go on camera. It's like so fun. This is my social life now, guys.
Marina, I felt like saying that to you. Like, okay, are you checking out all of our events? We do.
Yeah, where are you, Marina?
Yeah, where are you based?
I'm looking at you guys, and you're in Seattle and all the coast. I'm in Omaha, Nebraska.
Okay, well, we do a lot of online networking. I hear you, but there's, this is, I feel like one of the best things that you can do right now is like try and find as many virtual networking, events, and they are happening. And I think, yeah.
I'm definitely gonna check your guys' site and
like
pick
one thing. Like pick one thing. Pick one conference that you can get excited about. If you are able to like travel, pick one thing per year or like 2 things per year and make that your in-person, so that, because I do think that being in like a flyover city makes it a lot harder, for sure. And Seattle used to be that way a decade ago. So pick something and go. I think it'll be worth your time, but there's a lot that you can do virtually. Yeah, I was like, I'm not going to Nebraska, unfortunately.
Awesome. Okay. Well, I want to close by saying thank you, Leslie. I know, you have to jump. This was just super, super helpful. Hopefully, the rest of you who are staying for, for the networking sessions, stay tuned. And Jenna is going to break us out into rooms. We recommend that you are starting by having everyone who wants to pitch. And if you are pitching an idea, then try and keep it under 3 minutes. We also recommend collecting the emails of those in the breakout room, because this is, this is the time for you to exchange information, add each other on LinkedIn. And, for a lot of us, this is, it's hard to meet other founders. So this is your opportunity, okay? Like talk to other people who are on this journey with you and keep each other's emails and stay in touch. Great. So the rest of the hour is yours. And are you going to break us out? Do you want me to? Wait. There's a couple of, Jenna, I'll let you take this.
Okay, sounds good. Yeah, a couple more things just so you guys are aware. You are able to move around rooms. You'll be able to select. So while I'm assigning you based on the polls that you did earlier, after you guys are done with your conversation, you can either kind of keep talking in your room, you can move to another room, you can move into a separate room that I've just labeled breakout, and you can just have kind of one-on-one conversations if you'd like. So this time is yours. You can do what makes most sense for you in your rooms. I'll also put some prompts maybe in the chat, and if you want some conversation topics as you're meeting, but otherwise it really is your time. So if you also, after I open up these rooms, if you were not here to do the poll earlier, you should just be able to see them and join whichever room you would like to. So have some flexibility.
It was lovely meeting you all, everybody. Thank you.
I'm signing off. Bye, everyone.
Yep.
Thank you so much for your time.